Ladies and gentlemen, good day and welcome to the Nippon Life India Asset Management Q4FY23 conference call hosted by Batlivala and Karani Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Swarnabh Mukherjee from Batlivala and Karani Securities India Private Limited. Thank you and over to you, sir.
Thank you, Zico. Good morning, everyone. On behalf of Batlivala and Karani Securities, I welcome you all to Nippon Life India Asset Management Limited Q4FY23 earnings conference call. We have along with us Mr. Sandeep Sikka, Executive Director and CEO, along with the top management team of Nippon Life India Asset Management. I would like to hand over to Mr. Sikka for his opening remarks. Over to you, sir.
Thanks. Good morning and welcome to our Q4FY23 earnings conference call. We have with us our CFO.
This call is now being recorded.
Co-Business Officer Saugata Chatterjee, Co-Business Officer Ashwin Duggal, Chief Digital Officer Arpan Saha, Head of Product Management and Investor Relations Arun Sundaresan, and Mutsui-san, nominee of Nippon Life Japan. Our detailed presentation and press release have been uploaded on the exchanges as well on our website. I would like to break my comments into three parts. 1. Industry overview, 2. Our performance, and 3. Way forward. Since this is only the financial year end, most of the commentary would be for the whole year. For the fiscal year, equity markets were volatile and ended the year almost flat, S&P BSE Sensex returning 0.7%. Small cap returned negative 7%. There was an increase of 250 basis points based on the repo rate, while the 10-year G-Sec went up by 50 basis points. Despite the mixed overall outlook in the beginning of the year, the subsequent latter market returns, the asset management industry maintained its growth momentum driven by increasing financialization, higher awareness, and improved access to mutual fund products across the length and breadth of the country. The industry AUM grew by 5.5% in the year and is currently at 40.51 lakh crores, a historic high. The equity category, including index and excluding arbitrage funds, witnessed a gross inflow of 5.72 lakh crores and net inflow of 2.52 lakh crores. Investor interest for investing through systematic investment plans was very high, with the SIP contribution for the year being at 1.56 lakh crores, 25% higher than last year. The monthly SIPs touched an all-time high of 14,276 crores per month, while the SIP folios were at 63.6 million, risen by 20%. Debt funds, on the other hand, witnessed an outflow of nearly 1.5 lakh crores on the back of rising interest rates. ETF flows were healthy at nearly 60,000 crores of net flows during the year. The consistent expansion of investor base and growth in the AUM driven by SIP and ETF flows indicate investors' interest in the industry's superior capability to fulfill them vis-a-vis other financial products. Growing financial awareness, differentiated and transparent product suite, and innovative digital strategies are expected to be the key driver for industry growth in future as well. At Nippon India Mutual Fund, our priority is to be future ready and capture this long-term opportunity. As on March 31st, 2023, NAM India's assets under management were 3,62,981 crores, that is 42.2 billion USD. This includes mutual funds, managed accounts, and offshore funds. For the quarter ending March 31st, 2023, our mutual fund quarterly average assets were at 2,93,159. This is a flat Q1 quarter-on-quarter and an increase of 3.5% year-on-year. In the previous meetings, I emphasized on our equity market share. I'm happy to share with you our equity market share excluding ETF has been stable for last 3 quarters and is currently at 6.19%. Share of equity assets rose to 44% of our total assets compared to 42% last year. We added 9.6 lakh folios in this segment. With our strong on-ground presence and healthy fund management performance, we hope to increase our equity market share in coming days. At Nippon India Mutual Fund, our core remains on investors' interest. We added 2.6 million folios in the year and continue to have the largest base in the mutual fund industry at 13.5 million investors. We have one of the largest retail assets in the industry at 85,261 crores. The retail assets contribute 29% of Nippon India's AUM compared to industry average of 25%. Our B30 AUM is at 55,680 crores, which has increased by 16.4% year on year. This segment forms 19% of the Nippon India Mutual Fund's AUM compared to industry average of 17%. In individual AUM, that is a mix of retail and HNI, is at 1,62,000 crores, an increase of 17% year on year. This segment contributes 56% of the Nippon India Mutual Fund AUM. One of the areas of improvement, as I have highlighted in the previous calls, has been our market share in HNI category. I am happy to inform you that our HNI AUM increased from 77,289 crores up by 15,500 crores, which is 25% up year on year, and our market share increased by 66 basis points. Systematic flows are a stable and a key driver for industry's long-term equity flows. I'm happy to share that over the last few quarters, Nippon India Mutual Fund has seen strong growth in systematic investment flows, and this has led to a sequential increase in folios and value market share. Our systematic book rose by 52% year on year to 1,115 crores. This increase results in an annualized systematic book of 13,380 crores. 60% of our SIP AUM has continued for over 5 years compared to 24% for the industry. Also, in volatile markets, folios with lower ticket size have demonstrated longer vintage and better stickiness. 15% of our SIP folios have continued for more than 5 years against an industry average of 11%. At Nippon India Mutual Fund, we offer best in suite of products in the passive category. With strong growth in industry passive, our ETF ecosystem is already in place and far ahead of its peers in terms of investor base and mind share. We continue to be the largest ETF player with an AUM of 70,000 crores with a market share of 13.74%. Gold ETF is the biggest fund in the category, and in this period, even silver fund, we are the largest in the industry. Our share in industry ETF folios is 61%. We have 70% share of ETF volume on both NSE and BSE. Our ETF's daily volumes across key funds remain far higher than the rest of the industry. Under Nippon India AIF, we offer Category 2 and Category 3 alternate investment funds and have a commitment of 5,615 crores across various schemes. Our digital-centric strategy is one of the keystones for sustainable growth and profitability. Amongst various digital initiatives such as cart buying, which we took to enhance our partners and investor experience, we have rolled out Nippon India Mutual Fund WhatsApp channel, a real-time comprehensive transaction and service suite for our investors. Business Easy 2.0 app is aimed in driving more meaningful engagement, retention, and growth through advisory, detailed analytics, and smart insights. Digital purchase transactions rose to 33 lakhs, up from 30 lakhs last year. Digital channels contribute 57% of our new purchase transactions. While I talked about digital infrastructure at Nippon India Mutual Fund, we have a well-diversified physical distribution base, a wide presence through 270 locations across the country. We have 91,000 distributors and panel with us. The MFD base rose to over 9,800 and an addition of 6,700 distributors during the year. Now on the financial performance. For the quarter ended March 31st, 2023, profit after tax is rupees 1.98 billion, an increase of 13% year-on-year. The operating profit is at 1.99 billion, which is flat year-on-year. In the past, the company has followed a consistent dividend policy, and we are following the last year's dividend payout, which was 96% of PAT ratio, and this year the ratio has gone to 100% of PAT for the current financial year. Over the last 9 financial years, NAM India has distributed a cumulative dividend of rupees 41 billion. As we grow organically through our physical and online channels, we remain open to evaluate investments in strategic opportunities that add to the profitability and complement our existing businesses, and ultimately in the interest of the minority shareholders. As a signatory to UNPRI, we are integrating ESG aspects to the various areas of planning, operations, fund management, and risk governance. Our goal is to encourage higher adoption of ESG principles within the asset management industry. As a responsible investment manager, we are building a resilient portfolio that will not only provide sustainable return to our investors, but will also have a positive environmental and social impact. We will also seek apt and relevant disclosures on ESG matters from our investee companies. To sum up, I would like to reiterate, at Nippon India, investor centricity remains the key theme. We strive to deliver superior experience and sustainable returns to our investors, and in the process add value to our stakeholders. Our endeavor is to provide sustained profitable growth in the coming quarters. We do hope that the interest rate scenario globally and domestically will be closer to peaking out, if not already peaked out. This may be a positive scenario for capital market investments, both equity and fixed income asset classes, and will encourage further mutual fund investments. With these comments, we are happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Mohit Surana from CLSA. Please go ahead.
Yeah, hi, good morning, sir. Sir, one question from my side. When we look at your equity scheme performance, it's Nippon Mutual Fund has done quite well across top categories. But we have not seen that being reflected in market share. As you said, market share remains flattish. So any thoughts on, when the improved scheme performance starts to show up in higher market share?
Thanks, Mohit. I think the way I would like to see it, typically good performance, I think there is always going to be a lag in performance, the inflows. From our perspective, I'd like to give you 2 data points, I think, which will help you to understand. I think first, because our focus is highly on retail, I think our systematic flows have already increased 50% during the year. And from almost 650 crores have gone to touching more than 1100 crores on a monthly basis. So all this will have a lag effect, I think, for the incremental net inflows into the company. And also, while I think if you were to look at it, throughout the year it was the market share was flat, but if the last 1 or 2 quarters, the net sale numbers are higher than the market share. So both these will indicate, I think in the coming quarters, I think slowly and steadily the market share will keep increasing.
Good. Thank you, sir.
Thank you. Our next question is from the line of Prayesh Jain with Motilal Oswal. Please go ahead.
Yeah. Hi, good evening. Good morning, everyone. Firstly, on the yield front, the sequential decline is just because of product mix, or is there anything else that you would like to highlight out there?
Prayesh, I'll request Prateek to take that question, please.
So, Prayesh, in terms of the sequential quarters, I think the yields are more or less flat. But in terms of the overall, if you look at the full year, it has moved down from 44 basis point to 42 basis point on the MF side, which is typically we have been mentioning that it is because of the three factors which you have said in the past about the replacement of old asset by new assets. The cost of acquisition of the newer assets is higher as compared to the older assets, and third is the increase in sizes. However, the pace of this decline, which used to be higher earlier, has come down for two reasons. One, of course, we are seeing a lesser churn now, given we believe our equity performance has been good, and also the bulk of the replacement has already happened. The other thing is that we have also seen the competitiveness or the payout ratios to the distributors has now moderated. What used to be in the last years, with the slew of NFOs, etc., that has also moderated, and therefore, we have been able to contain this decline, and that is where we see ourselves continuing. That's all from my side.
Okay. So from like in the past, I think we have kind of alluded to the churn as, churn impacting the equity is the 1 or 2 basis points on an annual basis. Do you think that is still there, or we should assume that is kind of, gone away, and now, it should be, say, much lesser, and it should be more of a impact of the increase in AUM size rather than anything else?
No, so as we said, again, Prayesh, that there will be a marginal decline which keep happening. However, if you look at the debt yields, that will see some kind of an uplift, because the net return to the investors have gone up, from what was about 4.5% overall returns on the shorter duration funds to about 6.5% this year. Obviously, there is a flexibility for us to charge marginally higher, and therefore you will see that the yield improvement on the fixed income side.
Okay, got that. And just continuing on the debt part, what you mentioned, so how do you read the impact of the taxation that was levied by the government of India? Do you see that there is an opportunity in a certain hybrid category where the equity portion could be between 35% to 65%? And how do you see the overall debt kind of flows moving in terms of the near term?
So what I'll do is, I'll ask my colleague Ashwin to answer that. But from a tax perspective, if you just ask me, the mutual funds still remain a superior product as compared to any other product in the market, because of the flexibility and by which one could redeem and get their money back, and at the same time, it provides a higher return to the investor, and the taxation is also at the end when the person is kind of redeeming it. Therefore, during the holding period, there is no taxation involved. So there are a few things which, from a tax arbitrage perspective, there still remains. And I'll ask Ashwin to talk about how he sees flows from the investors.
Hi, Rajesh. This is Ashwin here. Thanks, Prateek. So largely, the shorter end of the curve, which is up to 1 year, essentially, in our view, will remain unaffected, from flows. It is the belly of the curve and beyond, which is your 3-4 years and beyond, where we were seeing bulk of investments coming in from savers. There I think, we'll be competing with some of the other savings products. However, I think taking a cue from what Prateek mentioned, there are two very essential features of, debt mutual funds. One is diversification. So with a very small ticket today, the essential benefit of exposure into multiple debt instruments that can be derived from investment in a mutual fund scheme, that continues to be a big benefit to investors. Number two, tax deferment, which Prateek mentioned. I think that is one unique benefit that only mutual funds, provide, and that over a long investment period for a retail or an individual investor can be very meaningful. So I think some of these, benefits will continue to be inherent to mutual funds. Any which ways, the population of investors who were getting tax benefits, was smaller. Okay, and I believe that, once AMCs, now focus on explaining these benefits of, diversification and more importantly, tax deferment, I think over the next, in the medium term, I think we should continue to see large flows. So very, very confident of, debt funds getting now longer term AUM than what they have got in the last 3 years.
That's helpful. Just a question on the financials here. The employee cost is down sequentially and YOY basis both. What is this related to, and can you break down the full year expense in terms of ESOP and non-ESOP expenses? And what is the outlook for, say, next FY24?
So, see, from our perspective, we have not given any ESOP for the last 2.5 years, and bulk of that has been, accounted for, because in terms of ESOP accounting, the cost is front-loaded. As far as the decline is concerned, both sequentially, it is because of the, our expectation in terms of growth and profit. So we have been continuing maintaining certain provision for the PLI, and that has somewhat moderated from what our expectation was, and therefore the numbers are slightly lower.
I think we'd like to highlight, as a company, we continue working on operational efficiency. There's a lot of digitalization that is happening at the back end. So we are clearly seeing an advantage of that also playing out.
Okay, for that. And just last question, any reason for the other income fall in this quarter? Because the yield is there a yield impact, or how? What should we do?
Yeah, this was purely the mark to market. We carry almost 2,200 crores of our net worth into our fixed income schemes, and this was predominantly the mark to market on these schemes as on date.
Got that. Thank you so much, and all the best.
Thank you.
Thank you. Our next question is from the line of Lalit Deo with Equirus Securities. Please go ahead.
Yeah, hi sir. Good morning, everyone. So just two questions. So firstly, we have seen strong additions in our passive fund folios. So how incrementally are we looking to do something in terms of cross sell to these existing investors to where they can subscribe to our equity schemes also, and then we can see probably some increase in market share also?
So Lalit, I think you're right. I think our focus has been, to acquire newer investors. We strongly believe, this long-term success of the industry or for any company will be, if you're able to increase your investor base. So I think by design we are adding more and more investors, and there is, at the back end, a lot of initiatives are being taken using AI, and various initiatives are being done to cross-sell and upsell different products.
Sure. And so secondly, the question was on the yield side. So could you give us the segment-wise yield as on March 23 across, on a book basis?
So, historically we have not been sharing the yields on a product basis, but in terms of the as we have in the past maintained that the equity yields are in the range of close to about high 70s to early 80s, and on the debt side, it has been because the most part of the debt has been on the ultra short-term category, so that has been around around 23 to 30 basis points, somewhere in that range, and on the liquid it has been around close to about 15 to 20 basis points. So this is where the overall yields have been.
Sure. And so last quarter we highlighted that we have seen some increase in yields in our passive funds. So how are those yields holding up, and do we see any other areas also to increase yields in those schemes?
So Lalit, we keep evaluating wherever we can. I think wherever there is scope. I think it's you have to juggle between how you are adding value to the investor. I think wherever we feel there is scope, we'll do that. I think it will be very difficult to give a long-term projection how we'll go ahead. But whenever we see there's an opportunity, we keep working on it.
Awesome. And so just last data question. Can you give us the new SIP registration number during the quarter? New SIP registrations which happened during the quarter.
Lalit, we published this data about total systematic investments, not only SIP, because this is also structural in nature. So for the month of March, it was 1,115 crores, and for the quarter, 3,200 crores.
Yes, but in terms of folios, give it.
Folios for the entire year, we have added 26 lakh total folios. Out of that, systematic investment plan is
So I think it would be roughly we are adding 1,20,000 approximately, plus minus a little here there. I think Arun can share the exact data with you.
Yeah.
But I think it would be for the full year about 12 to 14 lakhs, kind of a number. But exact number, I think I will get back to you.
Yes. Thank you.
Thank you. Before we take the next question, a reminder to all participants, to ask a question, you may press star and 1. Our next question is from the line of Mr. Swarnabh Mukherjee with Batliwala and Karani Securities. Please go ahead.
Yeah, thank you. So my first question is on the yield. So you've mentioned that yields are flattish sequentially, which is the case for the mutual fund business. But if I look at it on a consolidated basis, we do see some amount of compression there. So just wanted to understand anything which has played out on maybe the managed account side, which is outside the mutual fund business, which has resulted in this.
No, I think broadly from our perspective, outside the mutual fund business, there has not been much growth. I think we saw some of our existing funds, they had to close down because I think they got matured. And new fund launches got a little delayed. But I think this is a temporary nature. So I think we already have a certain new fund launches lined up. And I think so in the coming 1 or 2 years, again, you'll see that picking up.
Okay, got it. In terms of, this yield, when we try to think about how it will play out over the next 2-3 years, just wanted to understand, how much of your old assets have already gotten turned into new assets, or maybe if you can break up your current on the equity side, the asset mix between assets older than 3 years and very newer assets. If you can give a ballpark number to help us understand.
No, so see, almost about close to about we only have about 30% of the old assets now, which are on the which are in the old pricing. Rest all has been churned, already have churned, and so the more than 3-year-old assets would be about 30% of our total equity asset, and most of it, as Arun mentioned, is part of our SIP book, the continuing SIP book. So we don't see much of a change happening at that end.
So would it be fair to assume then that the realization that we are making on the stock is now relatively closer to the flow levels right now in terms of yields?
So, see, as I mentioned to you, that look, the flows also depend on which category we are seeing the inflows, and in certain categories, our propensity to charge is slightly higher as compared to some of the other products. It is, as we said, it is a function of competition, our performance, as well as the size of our scheme. So, as Sandeep mentioned, that we keep evaluating all the opportunities available in terms of transforming the growth as well as at the same time maximizing our revenue.
Sure. And sir, last question I wanted to ask on the gold ETF side. So, how have the flows been post this, taxation norms are announced for non-equity mutual funds, and what impact do you see on this? Do you see any impact at all?
So I think broadly, I think the way we have to see this is, I think our gold continues. I think it has been the largest gold ETF in the country for about many years now. A lot of investors, different investors come. Some come for a short-term tactical view, some for a long-term. There are different treasuries. So I think we don't. There is too early to say what will be the impact. But I think majority of the investors, I think, who have been coming for short-term or less than 3 years, I think nothing changes for them. So overall, I think we clearly see both gold and silver. Gold and silver. I think more allocations coming into it. I think one more trend that we have seen is, I think a lot of HNS family offices, I think they keep taking tactical calls, on gold and silver. And I think because of the volumes that we have, I think ours is one of the most preferred ETF.
Thank you so much, sir.
Thank you. Our next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, morning all, and thanks for the opportunity. So one question, which is on the market share. So what seems to be the likely reason for divergent trends in SIP flows versus your lump sum flows? So on SIP side, we are consistently seeing improvement in market share, but on the lump sum flows, there seems to be huge outflows. So what seems to be the likely reason?
I think it's very simple. I think for the organization, for us, I think we have always been very strong in retail. I think there was a period when our fund performance was not so strong. After the fund performance getting stronger, I think we have seen the SIP numbers, as you mentioned, have been strong. Last year we added, I think, to answer one of the earlier question which had come, 19 lakh SIP during the year was the number. At that time the number was not available with us. And that will definitely add value on a monthly basis. If you're adding 1,000 crores, so this is, so technically speaking, now the annualized SIP book is about 13,000 crores incremental inflows that will come into the company. As far as the, again, go back to, if you go to the last 5-6 calls, I think we have been saying that we have been relatively weak. We were weak on HNI, and now that is also improving. I think we have seen a growth, our HNI market share go up by 66 basis points. There has been an overall increase in AUM of 25% compared to the industry AUM of 11%. So I think that it will be with a lag effect. I think nothing specific. I think once the basics are, the core is in place, I think it's all about execution. But I think overall, we feel, I think the trend that you have seen in SIPs, which started a little earlier, you will start seeing in lump sums also. And we remain positive with the next 4 to 6 quarters. You will see equity market share going up.
Got it. That's all from my side. Thanks for answering this.
Thank you. Our next question is from the line of Mr. Mohit from Bob Capital. Please go ahead.
Thanks for the opportunity. Couple of questions. First, if I look at the SIP AUM, it has declined sequentially from 583 billion to 580 billion. So what explains that?
I think it will mark to market, nothing else. I think overall the numbers and the monthly numbers have been increasing. I think it would be just that, nothing else. Both the number of count and the overall monthly registrations, number of new investors, and monthly inflow, all have been increasing. As I mentioned earlier, it's almost gone up by 50% in the last year.
All right, perfect. Second is in terms of the dividend payout side. I think from the last 2 years we have been given more than 90%. But I believe that it will moderate going further, or do you intend to make it more than 90% consistently?
So this year we have gone for 100% almost. I think as per our present dividend policy, anything between the 60 to 100%. I think depending on how the board evaluates going forward, I think decision will be taken. But broadly, the thought process is we want to share the profits of the company with the shareholders and the minority shareholders. We cannot give a futuristic thing, but as a dividend policy and going by the past trends, we'll be similar to where we are today.
All right. And my last question is in terms of the tax. If I look at the effective tax rate, it's at 17% for the quarter, primarily because of the deferred tax credit. And even if I look at the entire year, we had a deferred tax credit. So, prudent to assume that we'll take this deferred tax credit going forward, or 25% tax rate is something that we can assume for the future.
No, so see, Mohit, we on our fixed income investments, we get the long-term benefit, and as and when they turn long-term, so what we do when we invest with them and whatever gain is there, we provide on the basis of short-term rates till the time they become long-term. So the moment they become long-term, both on equity and fixed income, we have to do the assessment of our tax calculation once again. However, even if we don't realize, we have to do this adjustment, and therefore you see the changes in the deferred tax. So, significant part of our investments, during the year has become turned long-term, and on that the tax liability has to be adjusted based on the long-term tax rate as compared to the short-term, and therefore you see in the fourth quarter, there has been marginal lower provision for the taxation. However, what we expect, because there is a part of our income which comes from other income, so we expect our effective tax rate to be somewhere around 22 to 23% as against 25.
All right, perfect. Thanks, and wish you all the best.
Thank you.
So your question on the SIP numbers have gone down. If you see the slide number 29 for presentation, actually the SIP book has grown from 45,000 crores to 50,000 crores. So maybe I think for further clarification, I think Arun will be in touch with you. But slide number 29 gives you that data.
Thank you, sir. Our next question is from the line of Abhijit Sakre from Kotak. Please go ahead.
Hey, hi, good morning. Is it possible to share your net flow market share for last couple of years?
So, Abhijit, we do not, disclose the net flow market share. However, if you see in the last few quarters, our decline has, on the market share has, more or less stabilized. And so we are seeing some positive, inflows in terms of, or our net sales are higher than our existing market share, and you will see in coming quarters we will be able to improve the trajectory.
Okay, so the flow market share is higher than the current AUM market share in recent period.
Yeah, that's right. Yeah.
Okay. The second one was a broad color. If you can share any color on type of investors and channels that are bringing those investors between, let's say, the active equity versus the passive equity book that we have.
So I think from the investors' point of view, as we mentioned, I think majority of our investors are retail, even from the AUM point of view, while the industry has an average of 40% institutional AUM. I think for us, I think the retail is the dominant one, which is retail, individual plus an HNI, so that is one. So majority of the investors which are coming are individual investors coming from across the country. I think we continue because of our digital infrastructure. We are having 9 purchase transactions per minute. So I think these are our is a mix of digital savvy investors as well as investors coming from small cities and towns. As far as the channel mix is concerned, I think we have not the channel mix between active versus passive, if I was to say. In passive, we have seen many investors are coming direct. Many or most investors are coming direct, and many of these are also family offices. In active, majority, very high percentage still keep coming through IFAs and national distributors.
Okay, got it. Sorry, are you also seeing on the passive side, are you also able to track if these new set of investors are first-time investors in mutual funds, or this is probably their second, third product on the mutual fund side, which is becoming a passive product?
We will not be able to have that data, but our sense says many of the investors who are coming into the ETF industry, I think they are first-time investors. I mean, that's again, like I said, I don't want to put, because these are some of the new investors which are coming there. The fact that we have 70% of the market share in ETFs, and I think 1 out of 3 investors in Indian mutual fund industry is with us. So the trend would be likely the first port of call for any new investor typically is Nippon, whether it's ETF or this, and then it graduates to the industry.
Okay, got it. Thanks a lot.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question is from the line of Bhavya Sanghvi with Fortress Group. Please go ahead.
Hello. Hi, sir. My question is on the non-mutual fund piece. So I wanted to understand the business model, also get some flavor on the yields and the kind of margins that you make on managed AUM, which I think is reported at 673 billion. And could you just, give us an idea about, the traction and the size of opportunity in this space? And how is it different from, the mutual fund piece in terms of operating numbers? Thanks.
So I think broadly, I think we have already discussed a lot about the mutual fund business, and I think we clearly believe, I think as far as the mutual fund business is concerned, it is the scale of infrastructure and I think the execution capability that we have built up. I think we clearly believe we should grow in line or a little better than the industry going forward. I think from the non-mutual fund business, yes, this financial year has not been very good for us. I think it's a mix of multiple reasons. Like I said, some of our funds which were there reached up and they were close-ended funds when they matured. Then after that, I think also we went slow on our real estate offerings and 2-3 new funds which are getting launched got delayed. I think from our perspective, this opportunity is going to be divided in 3 parts. The domestic fundraising in the non-mutual fund, which is going to be both real estate, B is going to be long-short funds, B is going to be the international funds, I think, which we are working closely with Nippon Life to see the opportunity to get the investors into India from Japan. We already have 3 funds, 2 bond funds in Japan, 1 equity fund in Japan, then 2 real estate funds in Japan. I think there is we are exploring how and what more we can do. There has been a little delay, and I should admit, I think this is something which has been a little slower than what we thought, but there's a lot of work that is happening, and in the coming quarters, you will see a lot of traction. We are also, as we have been mentioning in past, we continue exploring opportunities for inorganic opportunities. We also continue looking at acquiring skill sets that complement our existing businesses to start new product offerings which we do not have at this point of time. So the next 3-4 years as a company, there will be a high focus on AI, a non-mutual fund business.
Sir, can you, give us a sense on the yields that you would make on this kind of a business? Retentions on mutual fund business would be, just a proportion, would it be double of what you make on mutual funds, and impact on the margins going ahead through this business?
So, we need to break this up into 2 parts. One is there is a government business, which is the postal life business, which accounts for almost 60,000 crore of assets, where, we make, there is a very little margin of fees, I would say. That is, because that is a government mandate. However, on the PMS, AIF and the offshore businesses, which accounts for almost like the offshore business is close to about $1.8 billion, and on the AIF side, the commitment which is about 800 odd million. So there, I think what we make is on the AIF and PMS, our net retention is about close to about 100 basis point, and on the offshore piece, this would range about in between from 33 basis point to 67 basis point, depending on whether we are sub-advising or where we are managing. And these are mostly institutional mandates, what we are currently running. On the retail side, on the offshore side also, we have, net realization, which is in excess of 100 basis point.
Sir, $1.8 billion was for offshore business.
Yeah.
Right. Okay. Thank you, sir. Got it.
Thank you. Our next question is from the line of Pritesh Chheda from Lucky Investments Managers. Please go ahead.
Sorry, sir, if this question is repetitive, but I just wanted to understand your directions on yields, especially in context of the last, full year, whether for the industry as a whole as well, where we had multiple challenges on yield, whether it's with respect to mix or NFOs. So any comment in terms of yield direction?
Also, frankly speaking, it will be difficult to, tell about the industry. But as we have been maintaining that, look, we would like to continue to maintain the current levels, going forward as well. So wherein, our net yields, are in the range of about 40 to 45 basis point. And there we clearly see scope because in the past few years, we have seen a sharp decline in our fixed income yields because of the lower net carry to the investors. However, now the carry is higher. I think we'll be able to, and as an industry, we'll be able to improve our, net realization on the fixed income side of it, and that will give us some kind of a fillip. On the other side, equity, we'll continue to see some marginal decline going forward as well as, because now this is linked to the size of the scheme, as well as the old assets getting churned out. So I think broadly, our endeavor would be to maintain the, current yields, which I think in the last year also we had said that, look, the decline would be in the range of 2 to 3 basis points. While we do not give any kind of projections for the future, but for the next coming years also, we would see that it would be in the similar range.
And my second question is, any comments on the competitive pressure on the NFO side, if any, in terms of easing or still remaining the same, or
So you would have seen that, look, typically NFOs, are not being there, and also the regulations are very clear that you can launch only one scheme in each category. And also, I think, from a distributor perspective, or the investor perspective, they have mostly realized that, look, because most of the fund which they launched Big Bang in somewhere around in August of 2021, what had happened is that, they went through a cycle where the return to the investors were not so positive. So on the peak of the market, when the funds were raised, they have not given, the expected returns. And therefore, both investors and distributors have learned this, and they have been, investing into the more established and performing categories. So we'll see, investor chasing returns in the categories where performance of the fund house has been good.
Yeah, as a company, I think we will not be, as a philosophy, don't want to come out with too many NFOs. The whole last year we have not come out with any NFO. And I think our focus will be to consolidate, to build scale on the back of good performance of our funds and scale them up.
So do you have your NFO, do you have your presence in the multi-cap, which was the last category launch?
Yeah, we have it. We have a multi-cap fund. We have the largest multi-cap fund in the industry is ours.
Okay. Thank you very much.
Thank you. Our next question is from the line of Mr. Aniket from BMSPL. Please go ahead.
Yeah, good morning. I just wanted to ask a question regarding the regulation.
Mr. Aniket, we are unable to hear you.
Am I audible?
Speak.
Hello?
Yeah, Aniket, please go ahead. Just be a little louder.
Yeah. So, good morning. Thank you for the opportunity. My question was on the debt side and the regulations that have come into place. So, previously on this call, you said that you don't expect the debt flows to go down that much in the longer term, but a lot of independent consultants which deal in debt and equity MFs are telling us that the business on the debt side has dried up quite a bit from the 1st of April. So what is your observation regarding this inflow going forward, and how will it affect the numbers for the company?
Hi, Niket. This is Ashwin. I will just explain what I said earlier. So what I explained earlier was that, the change in regulations have been mainly for investments that would complete 3 years and beyond. Okay, so what I said was the shorter end of the debt curve, which is investments which are essentially 1 year, close to about 1 year, okay, they will remain unaffected. And if you see the April flows thus far, okay, we have seen the flows have been close to about 60,000 crores at the industry level. So very similar to what we saw last year in same period. However, what I had mentioned was that at the longer end, okay, we have some benefits that mutual funds enjoy of diversification and tax deferment, where we as an industry will have to make efforts to educate, okay, our stakeholders like investors and distributors to explain them in greater detail. So what I mentioned was that in the medium to long term, we feel that on these premises and strengths, some of these debt funds should be able to compete much better. So that's our view on the longer end of the curve.
So Aniket, this is yet getting digested. This has come just about a month back. So, and also what you see immediately post the announcement, a lot of debt flows happen in the longer term, to go and catch up the the last minute tax breaks. So there has been a good amount of money which has already got invested into longer term, and therefore the amount available with the investors may not be much. And as Ashwin mentioned that we have some inherent as a mutual fund product, we have a lot of inherent advantages. And I think it's just from a distributor or advisor whom you're talking about, they just need to go and talk this to their end investors.
All right. Thank you for this.
Thank you. Our next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hi, thanks again. Just on this debt index fund, that segment has really picked up in the last 1 year. And so, where are we standing there, and how do you kind of see this impacting the yield in the debt segment, or what is our outlook on this segment?
Hi, Prayesh. So on the roll down products that you're talking about, I think yes, they have scaled up well in the recent past. But going forward, I think our focus will continue to be on active funds, because we feel that in the longer run they are able to perform better. However, it's a growing category, and even though last year we were slightly late in entering that category, in the last 3 months we have scaled up there as well. So in the nutshell, we'll focus on active funds. Okay, but we will continue to be present in the passive debt segment as well.
I'd just like to add one thing to it. Unlike equity, in debt, a lot of these passive funds were on the backdrop of the tax advantage which was there. So actually the way we see is focus will move in debt will move back to active funds, and organizations and companies which have a long-term track record of managing active in debt will benefit. So that's the way we need to see how things play out. But our first reaction is it is not going to be because of the tax changes. It's going to be the AMCs which were highly dependent on roll down or passive strategies in fixed income. They may get impacted, but the AMCs which have a long-term track record on active in fixed income may not be as much impacted.
Thank you. Our next question is from the line of Nilesh Jetani from Bank of India Mutual Funds. Please go ahead.
Yeah, hi. Good morning, and thanks for the opportunity. So a few questions on the fees and commission and other expenses. Just wanted to understand with the impending issues with regard to TERs from various aspects, from GST, brokerages, etc. I wanted to understand your view with regards to fee and commission. Do we have any scope to squeeze this going forward? And similarly on the other expenses, percentage of AUM, what direction can we give on that side, considering most of the NFOs, etc. are already out? So next year, are we expecting any further NFOs, and any direction on the other expenses on the overall AUM?
Yeah, so see, in terms of the fee and commission expenses, this is predominantly pertains to the our AIF business, where we used to pay upfront, and I believe there are regulations which will going forward these will not be allowed.
and most of this will be paid from the scheme as a trail. So therefore, this line item will not exist going forward. And also from, in terms of the NFOs, as Sandeep mentioned, that look, as and when there is an opportunity to come out with a unique product where we can give a differentiated return, to the investors, we'll work it out. Otherwise, just for the sake of raising capital, we'll not be coming out with any kind of an NFOs. As regards the, our overall other expenses, those are in the range of about 17 to 18 basis point of our current AUM. And as, we expect our AUM to grow much faster than the, as our expense growth. So typically our expense growth has been in the range of 6 to 7%, and that is what we expect going forward as well, in line with the inflation. And if we increase our AUM more than this expense rate, then the operating leverage will come into play, and you will see on a BIPS basis this will trend downwards.
Got it, sir. So my question on this impending impact from the GST and the brokerages, etc., to be included in TER. Any direction you can give us with regards to what could be our share or what industry could share, and what could be reflected or passed on to the on the bottom line of the investor?
No, so these are certain things which we have also learned from the newspapers. I think these regulations are yet to come out, and we would refrain at this point of time on commenting on those. However, if you go by the past, whenever these changes have been come, as our AMC has been most adaptable and flexible, we will pivot according to whatever regulation comes, and we'll work out a business model which is the most, or it would be the best for all our stakeholders.
That was really helpful. Thank you so much.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Sandeep Sikka for closing remarks.
I think thank you everyone. Thank you for being there. I think if there are any further queries, I think please be in touch with Arun. And from our perspective, our focus remains on long-term profitable growth. Thank you very much.
On behalf of Batliwala and Karani Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.